Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. Today, we are doing a deep dive into something, well, frankly stunning. It's this new reality for digital assets. How high-stakes geopolitics, even just political talk, can instantly shake the crypto market. It's chaotic, often unpredictable.
Yeah.
Our mission today is to really get under the hood, understand structurally why a single political statement, like say about Chinese tariffs, can suddenly cause billions, literally billions, in Bitcoin and Ethereum to be force-sold moments later.
It's a critical conversation to have right now. And the sources we've looked at, they really zero in on that market shock from October 10th and 11th, 2025.
Right, just a couple days ago.
Exactly. And it was kicked off by President Trump's big announcement. It came through various channels, social media included, threatening, get this, 100% tariffs on all Chinese products.
Wow, 100% on everything. That's huge. And it wasn't just the tariffs, was it? Because those are disruptive enough.
No, that's right.
He also floated the idea, crucially, of potential restrictions on core software exports. I mean, that sounds like a direct hit on the tech supply chain.
Precisely. And the immediate impact, it was just brutal. Bitcoin took a nosedive, specifically, plunged 8.4%, landing at $104,782.
Okay, an 8.4% drop is significant, but the real story seems to be the fallout from that drop.
That's the core of it. The scale wasn't just the price move, it was the chain reaction. Our sources are estimating something like 19 billion with a bead worth of leverage positions were just instantly liquidated, wiped out.
The $19 billion, just
Gone.
gone. Across the whole digital asset market. That amount of forced selling triggered by a foreign policy threat, that fundamentally changes how you have to think about crypto risk.
Absolutely. You hear that number, $19 billion liquidated, and the big question is, how? How did a trade dispute, about physical things like electronics or clothes from China cause a meltdown in a supposedly decentralized digital world? Maybe let's walk through the timeline first.
Good idea. So the initial shock was so fast because it was like a 1-2 punch.
Okay. You had the big economic club of the 100% tariffs, right? But immediately alongside that, you had the more surgical threat restricting key software exports.
Oh, okay.
And that specific threat, that signals an immediate, fundamental risk to global manufacturing stability. The markets heard that loud and clear, and they reacted instantly.
And this wasn't just a crypto thing, right? You mentioned it went wider.
Oh, totally systemic. The sources confirm it. The U.S. stock market, the Dow, the S&P 500, the Nasdaq, they all dropped simultaneously. We're talking 2% to 3% on the same day.
So that confirms it wasn't some weird crypto quirk. It was a genuine macro event driven by that geopolitical announcement.
Absolutely. And what's also fascinating is just how fast the diplomatic side kicked in. China reacted, immediately. Strong criticism, pushback.
Naturally.
And they put out a public statement basically justifying tighter controls on their rare earth exports.
But
a clear signal, right? Reminding the U.S., hey, these strategic dependencies, they cut both ways.
Okay, so shock drop, diplomatic tensions rise. But then came the whiplash.
Exactly, which is just a perfect example of the kind of political volatility we're living with now. After this huge plunge, President Trump puts out a message basically trying to calm the waters. Something like, don't worry about China, it will all be fine.
Just like that.
Pretty much. And that single message, that attempt to soothe nerves, it triggered a rapid, although partial rebound across stocks, across crypto.
So it really shows how market sentiment is now hardwired to these big political statements, almost bypassing the actual economic data sometimes.
Completely. It's reacting in real time to the pronouncements, often faster than any traditional indicator can catch up.
Okay, we've established the shock hit everything stocks too. But, a 10% drop in crypto versus maybe 2-3% in stocks. That tells me the crypto market is acting like a massive amplifier here.
That's the key insight.
So let's look inside. What are the internal mechanics in crypto that make this volatility so, explosive?
Right. We have to start with what traders are literally calling tweet risk now.
Tweet risk.
The crypto market, because it's 247, fragmented across different exchanges, it's become extremely sensitive to political events, foreign policy schedules, especially things driven by these really visible, strong political figures.
But why is it so immediate? I mean, why are trading algorithms reacting faster to a tweet than, say, you or I can even read the news headline?
Speed. That's the crux of it. Geopolitical news hits these algorithmic trading platforms instantly, way faster than traditional news cycles.
So the high-frequency trading systems, the HFTs.
Exactly. These HFTs, they're basically pre-programmed. They scan constantly for keywords linked to known political risks. They don't wait for human analysis or, traditional market circuit breakers.
They just react.
They identify the risk from the keyword, trigger the first wave of mass sales, and then immediately start hunting for levered vulnerabilities elsewhere in the system.
Okay, so that initial vulnerability, our sources called it a weak buy-sell equilibrium. That sounds a bit academic. Can you break that down simply?
Yeah, basically it just means the market was incredibly brittle at that moment, like standing on thin ice.
Okay.
Specifically, the sources suggest there was very low order book depth. That means there weren't many large buy orders sitting just below the current price, ready to absorb selling pressure.
So no safety net.
Very little. And combine that lack of a safety net with extremely high open interest in highly leveraged futures contracts. Lots of people betting with borrowed money.
Right.
So if there are hardly any buyers waiting below, but tons of debt that needs closing out, if the price dips even slightly, well, that's a weak equilibrium. The external shock, the tweet, it just punched right through. Found zero resistance inside the market structure.
Okay, that weak structure sets the stage. And that leads us to the catastrophic part, the leverage multiplier.
Yeah.
Now, our audience gets leverage, but the key here seems to be how the speed of these automatic liquidations turns small dips into huge, forced sell-offs. Let's focus on that automated margin call process.
Right. So when you have millions of traders, all highly leveraged, even a relatively minor market downturn, like maybe that initial 1 or 2% dip triggered by the HFTs reacting to the news, that can be enough to trigger massive margin calls.
Okay.
And when a position drops below its required maintenance margin, the exchange, the platform, it doesn't call you up. It automatically liquidates the underlying asset. It force sells your Bitcoin or Ethereum instantly to cover the debt owed to the platform.
So it's not even a person panicking and selling. It's the system, the computer, forcing the sale.
Exactly. And here's the kicker. The HFT systems know this is happening. They see the liquidations starting, and because they're designed to profit from volatility, they actually accelerate the downward price movement. They start selling aggressively too, anticipating the forced liquidations. So that forced selling of, $19 billion worth of assets, it creates this terrifying cascade, like dominoes falling. One liquidation triggers the next trader's margin call, forcing more selling, pushing the price down further, triggering more margin calls, and it just rapidly amplifies that initial political shock by, I don't know, a factor of 5, maybe even 10.
Okay, that paints a really clear, if slightly scary, picture. The geopolitical threat hits, finds this brittle, highly leveraged internal market structure, and boom, it explodes.
Yeah.
So stepping back in the event itself, what does this intense correlation tell us about where digital assets are heading?
I think it tells us they're growing up in a way. They're integrating rapidly into the wider financial world. Crypto isn't just some standalone risk asset anymore, or just a niche thing for speculators.
Right.
This event really proved that crypto prices are now directly tied to major macroeconomic risks. Things like US-China trade tensions, obviously, but also supply chain shocks, especially around critical things like semiconductors, rare earth metals, and just general global currency and interest rate moves.
Okay, but let me push back on that slightly, because isn't part of Bitcoin's whole original idea that it's decentralized? A hedge against exactly this kind of government policy and fiat currency drama. If a US-China trade spat over microchips can crush Bitcoin, doesn't that kind of undermine the whole premise?
That's a really profound question, and it's one the market is grappling with. However, the sources suggest the impact we're seeing comes mainly from the institutional side of things.
The big money.
Exactly. As Bitcoin and Ethereum get adopted by large funds, pension funds, even big corporations putting it on their balance sheets, their capital flows tend to seize up when global stability is threatened. So when a big geopolitical event happens, institutional risk appetite just vanishes across the board. They pull money from all assets they perceive as risky, pretty much simultaneously.
Regardless of the underlying decentralization philosophy of Bitcoin itself.
Right. The institutional plumbing treats it as another risk asset in those moments of panic.
And that kind of reaction, that volatility, it's got to be attracting more regulatory attention.
Oh, significantly. The sources are unanimous on this. Repeated bouts of extreme volatility, mass liquidations, like that $19 billion deleveraging event, that massively increases the odds of heavier supervision down the line. For consumer protection regulators, this kind of event is like a giant flashing red light.
Where do you think regulators are likely to focus first? What are the immediate pressure points?
Looks like it's threefold, mainly. First, transparency. Specifically, the transparency and the operational resilience of the centralized exchanges where these massive liquidations actually happen. Can they handle the stress?
Okay, makes sense.
Second, stablecoins. Regulators are looking very intensely at stablecoins. Not just the usual audit risk stuff, but because the successful liquidation of billions in crypto often depends entirely on those stablecoins holding their dollar peg during moments of extreme stress. If the stablecoin breaks its peg in the middle of a panic,
The whole system could freeze or break down.
exactly, the whole liquidation mechanism relies on that stable peg. And third, they'll likely scrutinize other collateral-backed crypto assets more closely, too.
It's worth remembering, though, that not all crypto assets react the same way in these situations.
That is a crucial distinction, yeah. They're big players, BTC and ETH. They have much larger market caps, much better liquidity. They're better equipped structurally to absorb these kinds of large-scale event shocks. They bend, but they don't necessarily break as easily. They're kind of the foundation.
And the smaller stuff, the meme coins and the tiny altcoins.
Well, they're inherently less liquid. Often their price is purely driven by sentiment or, hype. They usually have weaker underlying fundamentals, if any, so they exhibit much, much higher volatility risk. If you're holding those kinds of assets during a systemic shock like this, you're basically hyper-exposed to the ripple effect. Collapse can be immediate and often total.
Okay, this brings us to the really practical part for you, the listener, the investor. What are the actionable takeaways here? How do we adjust our strategy to navigate, maybe even survive, this environment of high event risk?
Yeah, number one, absolutely top of the list, risk management. If a single tweet literally can trigger a multi-billion-dollar liquidation cascade, you must set clear limits on your leverage, period.
Non-negotiable.
Non-negotiable.
Yeah.
And establish absolute clear stop-loss points or, personal liquidation points before you even enter a trade. Don't wait until the panic starts. You should also seriously consider using hedging tools, things like options or maybe even short positions, to protect against this kind of sudden, politically driven downside.
Okay, so strict defense first, but there's maybe a silver lining in the timing aspect. You mentioned the market panics, but then it can also show that rapid relief response after the initial shock passes.
That's right. We saw it with the rebound after President Trump's follow-up calm down message. And the sources pointed out there was a similar pattern sharp drop, then rapid rebound during another tariff shock back in April 2025. So what this means is that immediate dip, the one caused by pure panic in those forced liquidations, it can present a short-term, potentially high reward buy the dip opportunity. And it's a big if you have the capital ready and, frankly, the stomach for that kind of volatility.
Right, you need to be prepared for that whiplash. So strategic portfolio balance sounds absolutely key in this age of tweet risk.
Absolutely. You probably want to maintain a core position in the more established, highly liquid assets, your BTC, your ETH. Think of them as your anchor in the storm.
Okay.
Then for altcoins, maybe treat that allocation differently, segment it, almost like it's a highly speculative venture capital within your overall portfolio. That helps manage the extreme volatility risk associated with those smaller cap assets.
And finally, tying back to that buy the dip idea, liquidity seems paramount. You need cash on the sidelines, that dry powder.
Yes, exactly. Because think about it. When a political shock hits and causes a sudden 10% drop, if you're already fully invested, maybe even leveraged up, you're just caught in the downdraft. You become part of the liquidation problem.
You're forced to sell, or you just watch it fall.
Right. But if you maintain some cash reserves or assets you can liquidate very easily, you give yourself the option, the capacity to potentially seize those very short windows, those moments when mass panic creates opportunity. So yeah, keep some capital ready.
So this deep dive really hammers home the main lesson, doesn't it? Political policy risk, geopolitical events, they aren't just background noise anymore for crypto. They are an inescapable, instant factor. And it's massively amplified by the internal structure, the leverage, the HFTs, speeding things up.
Yeah.
It means as an investor, you now need, sophisticated political monitoring, alongside strict risk management. It's not just about reading charts anymore.
The knowledge burden has definitely expanded. You almost need to understand the geopolitical schedules in DC and Beijing just as much as you understand blockchain fundamentals or market technicals.
Okay, so let's leave our listeners with this final, maybe provocative thought to chew on. Given that we're seeing these fast political events trigger sharp drops, often followed by almost equally sharp rebounds, what specific timing model or maybe signal system could an investor even develop to try and effectively capture that bounce back window? How do you potentially systematize trading this political volatility instead of just being a victim of it?
That's the multi-billion-dollar question, isn't it? Something definitely worth mulling over as you refine your strategy for this new landscape.
Definitely food for thought. Don't forget to subscribe and hit that like button.